In today's show, I'm calling it country and region valuation. And you're going to understand my country valuation guide. You're going to apply my FEMR tool to judge attractiveness. And you're going to see the most and least attractive countries in the world. That's what we're going to cover today. And my name is Andrew Stotts. I want to welcome you to the Valuation Master Class Show. And recently, I started doing this show, and I did it because I just have a lot to share and I want to get a lot of what I have out there. And I've told you that if you want the things that I'm putting out here, you just send me an email. And I want to recognize some of the people that have sent me emails. So recently, Jeremiah sent an email. Masigo sent an email. Saha Pratap, Christiana, Benjamin Lewis, who's in the Valuation Masterclass Bootcamp right now, Deborah, and many others. So I want to encourage you that if you have questions, feel free to ask those questions here, and I'd be happy to go into more detail. And also, if you want to get access to the tools that I'm sharing here, just send me an email. In fact, I'll share my screen right here, and you can see. Let me move my face for a second. In the bottom right hand corner, you'll be able to see my email. Just send me an email, and whatever it is that you want, let me know. And today I'm going to be talking about the country valuation. So if you're interested in that, just send me an email. Now, before I get into it, what I'd like to do is just talk briefly about when I started as an analyst. I knew nothing. It was 1993, and I got my first job as an analyst. I was 28. I was super excited, and I opened up the newspaper in those days. We had the Bangkok Post here in Bangkok, Thailand. I opened up the Bangkok Post, and what did I see? I saw all these companies and ticker codes and stuff, and so I just spent a lot of time learning about companies. I didn't really care about anything else at the time. And so I learned all the ticker codes and the companies and what's going on with the businesses. And slowly over time, I started to understand the market a little bit better. And then as I became a head of research and having a research team and working with that team, but also talking with clients, I was a sell-side analyst. That meant my clients were around the world. And I was talking to them about Thailand. I was talking about Thailand in the context of the region and sectors. And I realized I needed more data to have in my hands. And so I developed a lot of different things. One of them is this particular valuation guide that I developed. And I'm going to go through this valuation guide today and show you how I apply this valuation guide. Now, today, we're going to be talking about country and region valuation. This is not about stocks. That's the global stock tracker. But for this, I call it my valuation guide. So let's go into it and take a look, and feel free to ask any questions. I'm going to just check the chat and say hi. There's Deborah. Deborah, great to see you. And I'm going to keep sending you this stuff that I'm getting so that you got the tools that you need. So welcome to everyone else. Feel free to ask a question or just say hi. All right. So I've been working on this morning to prepare for this. So I'm excited to show you. And let's go ahead and go to the first page. And this is, now you won't be able to read most of that, which is okay. I'm going to go in more detail later. So don't get too stressed out about that. But my valuation guide covers 10 regions and 41 countries. And it's actually 2 pages. You're just seeing a front page. If you want this, just type country valuation into an email to me at Andrew Stotts, and I'll send you it. In fact, I'll send you other stuff that we've been developing so that you can use it and think about how you can apply it. So basically, this allows, this tool helps me to assess valuation across the world. What are things valued at these days? And that's an important thing for us to think about, and particularly in a valuation masterclass, we're talking all about values. So value is critical in that space, but also generally from an investment perspective, I have the portfolios that we run and things like that. I want to understand what's happening with valuation across the world. And so I built the FVMR methodology, which I've explained in a past session, and that's fundamentals, valuation, momentum, and risk. Think of it like a square or a rectangle. You have four corners. I want to look from four corners, from four directions at a particular stock or at a particular market to know that I've really covered everything. And that's when I developed the FVMR framework to help me get a big picture on the markets and also be able to really quickly catch up. And you're going to be able to do that when you receive this. So now let's go to the next section. So in the table, you're going to see it broken down by FVMR. Under fundamentals, you're going to see the ROE, the EBITDA margin, and the net margin. So you could EBITDA, you could say is kind of operating margin, and net margin. Some people call EBITDA cash flow, but that's a whole nother discussion. Under valuation, I'm going to show the PE, the price to book, the EV, the enterprise value to EBITDA, and the dividend yield. Now for PE, price to book, and EV to EBITDA, we want them to be as low as possible. Low is cheap. And dividend yield, we want to be as high as possible, because the higher the dividend yield is, generally the lower the price is. Now let's talk about momentum. I'm concerned about momentum that's fundamentally related momentum, which is sales and EPS. And I'm also concerned about the momentum related to price, which is I always look at local currency price when I look at these numbers. And then finally, risk. The risk things that I'm going to look at is debt to equity, or net debt to equity, in fact, and the standard deviation of the market. And that's all the measures that I can fit into this table. There's many more measures under each of these, but these are the ones that I want you to know and understand, okay? So now let's look at what we're going to do, right? So what can we do with this? Well, we can identify regions that are attractive or unattractive, or identify countries that are attractive or unattractive. And before we go any further, I want to talk about this word attractive. Many years ago, I set my goals that I wanted to be healthy, wealthy, and attractive. Well, if you look at my face, you can see I'm never going to be the most attractive guy, but that's not what I was talking about. I wanted to describe what attractive meant, and what it means to me is I attract good things and good people. That's attractive. And I hope that you are attractive and making yourself more and more attractive. And I had a professor in China when I was working on my PhD about 10 years ago, and he was a very attractive man, Dr. Lu Wei. What was so attractive about him was that he engaged students and invited them into the conversations. And he was just really good at that. So people wanted to be around him because he was attractive. So are you attractive? And if you're not attractive, figure out how to get attractive in 2026. But the reason why I'm talking about the word attractive is because I think if people are looking at stocks or markets on a one-dimensional aspect, they're never going to be as successful. So you could say, well, I'm a value investor and I like cheap. Yeah, but cheap is only as good as the price movement. If something's cheap and it never moves, then it's just cheap. And some people may say, well, I care about fundamentals. Okay. I have a company that I saw when I was an analyst that had really good fundamental performance, but the profit margin was so high that they could hardly grow because their price of their products were super high. And that brings me to the next one, which is momentum. I want to see that a company is generating forward momentum in earnings. And it would be even better if the share price was reflecting that or starting to reflect that. And that's the concept of momentum. And finally, risk. Again, from this lens of four directions, I need to take into consideration risk. Now, for me, I learned many years ago that I wanted to look at stocks across the world. I didn't just want to look to a small group of stocks. And that's when I realized I needed to use quantitative tools to narrow down. And by using these quantitative tools, I was able to narrow, investment universe down. By the way, I got some new curtains right there. They're actually old ones I had in another place, and I brought them in here because they're a little bit darker. So let's now go back to the presentation and understand that when I say that a country or a stock is attractive, it means relative to all the others. Does it mean it's a good investment? Not necessarily, but on the FVMR measures, it looks attractive. Okay, so let's now go into the next section of this, and this is our first country breakdown. So what I did is I looked at 41 different countries, and I ranked the countries based upon whether they were attractive or not on all of the measures, F, V, M, and R. And what I was able to do then is do a little scoring system. And from the scoring system, I could rank the 41 countries from most attractive to least attractive. And the reality is that I don't care about things that are in between. I want to understand the extremes. And in fact, for students of mine, they know that, I teach through extremes because extremes are ways that I understand things. Yes, Lee. Yes, I try to be attractive, and it's great to have you here. Yesterday, I was going to come online, and they told me that the electricity was going to be cut in our street. So I couldn't get on yesterday, but I'm happy to be back today. So here we can see, just looking at fundamentals and valuation, because I can't get it all on one slide. So I'm going to look just at fundamentals and valuation, and we can see that the world ROE is 16% and Asia Pacific is at 12%. If we go over, we can see Asia Pacific is trading at almost half the price to book of the world. So we can see a 2 times price to book versus 3.5 relative to the world. That tells me that Asia is super, super cheap. And ROE is below average. But ROE is not half. And so I think you could argue that maybe Asia is getting cheap enough that it's looking interesting. Now, in my case, Deborah's asking about FVMA. Now, I don't know what FVMA is, but my tool that I use is FVMR, Fundamentals, Valuation, Momentum, and Risk. And I've been using that for many, many years. Now, you can see China H shares, China A shares, which are the shares that are trading inside of China, and then Korea. These 3 countries are not attractive right now. And they're not attractive because ROEs are low, profit margins are low, and relative valuations are high. But if we look at Malaysia and Japan and Philippines here, we can see these countries, in particular Malaysia, it's getting a low ROE of 9, but you're also paying a low 1.4 on a price to book basis, and you're getting a 4.1% yield on Malaysia. So Malaysia looks interesting. What about Philippines? Well, they have a higher ROE of 14%, and the net margin of Philippines is 19%, incredibly high. Now, they have a lot of property companies and the like, which the composition of the sectors can determine a little bit of this. But, and then that's why nothing is truly comparable, but this is a good enough analysis. And we can see Philippines trading on 11 times PE and 1.6 times price to book. I would say that Philippines looks interesting, as well as Malaysia. Now, you're going to see later the remaining factors, but let's continue with fundamentals and valuation and apply this to Europe. So here we have developed Europe and emerging Europe. And what you can see is that Denmark is unattractive, Finland, unattractive, France, unattractive, Germany, unattractive, Netherlands, unattractive, Sweden, unattractive. Let's just look at Germany for a second, and you can see that Germany has a net margin of only 6% versus a global average of developed Europe average of 10. So We can also see the emerging Europe has a net margin of 12, so double Germany. Germany's really, really in a mess. Now, of course, you can buy stocks in the German stock market at 6 times EV to EBITDA, and that's, relatively cheap. But if you're getting a low profit margin, or let's say growth isn't that strong, then what's the point? Now, let's look at Norway as an example of a developed European country that's doing well or is attractive. Net margin is 10%, and EV to EBITDA is even lower than Germany at 4 times. Price to book is about the same, and PE is lower as well. Look at the dividend yield of Norway at 5%. This is a good sign that Norway is cheap. Okay. What about emerging Europe? Oh, this is where it gets really interesting. So if we think about this. So now we can look at the comparison of emerging Europe versus developed Europe. And what we can see is that emerging Europe is actually pretty darn cheap relative to developed Europe. In emerging Europe, you have, in addition, a very strong net margin of 27, 18, and 12. Now, you may ask me, Andrew, why is emerging Europe's net margin 12 on average when the 3 countries in it have 12 or above? Well, that's because I deleted a bunch of countries, right? Because I'm only focusing on the top and bottom 10 rather than all 41 countries. So the average is actually correct. It's just not an average of these 3. It's an average of these 3 plus some others. But look at the net margin of the emerging European countries, and they're trading on price to books of 1.3, 1.4, 1.5, and dividend yields between 4 and almost 5%. And that basically tells us that that is pretty attractive. Now, I want to talk about why do I keep talking about price to book? I thought we use PE most of the time. Well, the answer to this is that PE is a very, let's say PE can it can fluctuate quite a lot, and therefore you end up not being able to truly compare. And that's because PE is generally based on the forward year. Let's say 2006 as an example, or 2005. We're not done yet with 2005. We haven't gotten fourth quarter, so it can't be, we can't say a historical, 2005. But the point is that with PE, you're looking at 1 year. So it could be a bad year. And if it's a bad year, the earnings in the price to earnings ratio could be collapsing, and that could cause the PE ratio to rise. And therefore, what you find is that it's a very volatile figure. But if you go up the P&L to EV to EBITDA and you bring in enterprise value, then what you got is a little bit more stable. But if you go to price to book, then you're going to be comparing the accumulation of profit over many years. So the profit of a particular year just has a small impact on that number. And that's why when I'm comparing and thinking, I oftentimes look at price to book, even though we can say many people don't use price to book that much compared to PE. Okay, so now we got a picture of Europe, and we can see an interesting example of what's happening in Europe. And that is basically European countries are unattractive, but emerging countries are attractive. Now let's look at the Americas. And again, we're just looking at fundamentals and valuation. Now I'm not doing the red boxes anymore, so just follow along. Brazil, Colombia, Peru, Mexico, Canada, United States, relatively attractive countries. And what I would like to do is focus on a couple countries here. So one of the countries is Brazil, trading on, it's got a net margin of 10, trading on 10 times PE, price to book is about 1.8, and paying a incredibly high 5.3% dividend yield. Colombia, 6.5% dividend yield. Now, there's an important thing to understand about dividend yield, though, is that a high dividend yield also we have to compensate for inflation. And Latin America tends to be an inflationary environment. And therefore, there is an inflation component of the internally in that dividend yield. So just to be careful there. Now, let's look at fundamentals of the US. Incredible. Profit margin, 21%. EBITDA margin, 22%. And net margin, 13%. American companies are killing it with profitability, but you're going to have to pay a lot for it. PE, 26, price to book, 5.5 times. And then EV to EBITDA at 15 times and a very low dividend yield. So that gives a picture of what's happening in America. And this helps us to understand. So let's go back to that principle of dividend yield. If you look at the dividend yield of Indonesia versus Thailand, you'll see that Thailand is always going to be lower. And that's because Indonesia is a high inflationary environment relative to Thailand. And so people have to be compensated for that inflation in the country. You remember I talked to you about Fisher and all of his work. Well, that's part of what he talked about was the real inflation rate. So you could look at countries at risk inflation adjusted ROE. That's something I've looked at in the past. It doesn't necessarily have a strong correlation to picking an outperforming stock, but it's definitely a way to understand it a little bit more. Okay, so let's go back. And next, what I want to do is I want to look at the final ones. Of course, if you want this guide, just type in country valuation into an email and send it to me at Andrew Stotts, and I'll send you it. And for those people who have already sent me emails, I'm going to send this to you also today. So now we're going to look at momentum in earnings and momentum in price and then risk. So let's see what's happening. EPS growth, momentum in EPS in 2025 is growing at 10% across the world, 11% in Asia, ex-Japan, and then 7% in Japan. The countries that are growing the fastest right now are, for EPS, it is China and Korea. But the same problem that we have with PE, we have here with EPS. So what you can see is that there's a lot of volatility. The EPS of different countries is quite different, with Malaysia at 1 and Korea at 32% earnings. Well, one of the things, of course, is you have one-offs and other exceptional items sometimes. So I like to look at sales far up at the top of the P&L, because then there's much less distortions. And now we can see that sales across the world were growing at 4%, in Asia at 4%. And all of a sudden, Korea doesn't look as great. Neither does China A-shares. They're not growing their top lines that much, but there is some reason for an expansion in their EPS. And that's usually the case, that what we're seeing there is some margin expansion. So let's continue. I'm going to go back into this. And I would say Malaysia looks interesting here, because although it's slow growth, the share price hasn't really gone very far. If we look at column under momentum price, year number 5, we can see that the world was up 68%, but Malaysia was down 9%, and Korea was up 48%. So we can see from this chart where movements in share prices are. I don't have to look at, this is a table, I don't have to look at a chart to see that. Now here we can see is the volatility. So let's focus on the final column in this table, 1 year volatility of that market. And we can see that Malaysia has the lowest level of volatility. So although you may not be getting strong growth, you are getting lower risk. Let's look at Europe to try to understand what's going on. Look at the EPS column for 2025. Denmark, -5. Finland, -1. France, -7. Germany, only positive country, and it's up by 2%. Netherlands, terrible, -8, Norway -9, Sweden -6. You may ask, Andrew, how is Norway attractive? And yet it has earnings growth of -9. It's the worst earnings growth. Well, remember, it's 4 different things: fundamentals, valuation, momentum, and risk. And we can see that Greece and Hungary, they're pretty much in line with Europe. And then let's say Greece is the fastest growing. And then Poland has some pretty exceptional item of 47 EPS. Now, if we look at the 5-year performance, what we can see is that the biggest performer has been Hungary. Hungary has been rocking it. I also think it's interesting to look at the debt to equity, or in this case, net debt to equity. Finland's got a massive 1.8 to 1 debt to equity, whereas Hungary has almost no debt in Hungarian companies. Now, remember, if you want to get this, just send me an email at me@andrewstotts and I'll send it to you. All right. I know you're tired and we're almost up with time. So let's look at momentum for Latin America and the US. The revenue growth in the US is 7%. That's not bad, but the rest of the world is growing pretty quickly now. And EPS, although revenue was up by 7%, EPS was up by 14%. How does that happen? It happens because the US was able to expand their margin. And then if we look at share price performance over the past 5 years, it's 84% in both Canada and the US. It just shows how close Canada and the US are. But what's really interesting on this is how much debt Brazil and Canada have. The net debt to equity ratio for the past 12 months is about 147 in Brazil and 143 in Canada. Peru, almost no debt, and America's debt at 61%, or a ratio of debt to equity. It's very reasonable. This will tell you that we probably don't have a crisis in the US in relation to debt at corporates. And finally, the most volatile markets are Peru and Colombia, and Canada is the lowest volatility, and US is relatively low. So this gives you a picture of what I look at. Let's go back to the front and just remind you that if you want to get this guide, all you have to do is send me a message at me@andrewstotts and I'll send it through to you. This gives a picture of my valuation guide. I'm going to wrap up by saying, when I started as an analyst, I knew nothing. And I was trying to learn about companies. And then later I developed the valuation guides as a way of giving me an understanding of what's happening in the markets. After many years of looking at these valuation guides, it's all in my head. So last night I was speaking to a group of business owners. The numbers are in my head. The numbers may not be in your head, but if you get this from me, and then I'll update it on a regular basis, start looking at this, and then you'll start to see what's attractive where. That's it for today. I appreciate that you joined the Valuation Master Class Show, and hopefully we're going to see you in the Valuation Master Class Bootcamp. My name is Andrew Stotts, and I want to encourage you to build a competitive advantage